Hi everyone, my name is Tyler Sidlowski, and what I'm going to be going over today is the bond that could be wiped out by the California wildfires as my Wall Street Journal article. So just to go over a little bit of an agenda, what I'm going to be covering today is the background to PG&E, what exactly a catastrophe bond is, and the California wildfires that just ran rampant throughout the state over the past couple of months. So who exactly is PG&E? They were incorporated in 1905 and remain one of the largest natural gas and electric companies in the U.S. today. They're an American investor-owned utility company, and what they do is they provide natural gas and electricity in Northern California and are responsible for over 5 million households. And they range from they stretch up all the way in the north in Eureka in California, all the way to the Bakersfield, which is in the south of California. So, what exactly is a catastrophe bond? I thought this was important to go over because I really wasn't sure what it was as I was reading throughout the article. So I did a little bit of extended research on what exactly it was, and it's a high debt yield instrument that is typically insurance linked, and it's put in place for the purpose of raising money during disasters such as earthquakes or hurricanes, and specifically in this case, which is wildfires. And it has a special condition that if the issuer were to suffer a loss in a predetermined catastrophe, the obligation to pay interest or principal is either deferred or forgiven. And what exactly a catastrophe bond does is it transfers risk um, to the investors, and it lowers the reinsurance costs, and it frees up money for the company to invest with. It provides a payout to the company if the predetermined event occurs. So in this case, if PG&E were to be deemed responsible for these wildfires, that's exactly how this goes down. Um, so if you were an investor, why would you invest in a catastrophe bond? What they offer is they're not necessarily closely linked to stock market and economic conditions as, say, other bonds would be. And what they do is they offer a competitive yield compared to their risk, and they provide diversification benefits, and you collect interest upon your investment. Some of the risks to investors that would kind of push you away from investing in one is that it reduces risk to the company and it's placed solely on the buyer. Um, Although it is somewhat mitigated by short maturity, as these catastrophe bonds range from 3 to 5 years in maturity. And you can lose your principal if these events occur. So if the predetermined event were to occur, and in this case, which is a wildfire, you lose your principal. So, looking at the California wildfires, they burned more than 18,800 structures and are responsible for killing over 85 people to this date. And the utility company disclosed last month that a problem occurred on one of its high voltage power lines in Northern California 15 minutes before the start of the campfire that was reported in the area on November 8th. So, what this means is they're probably going to be deemed responsible. It's not 100% sure yet, but people close to the situation are leaning towards the fact that they're going to be deemed responsible for this. So I say, are they responsible again? Because just last year they were responsible for a 2017 wine country wildfire that also that burned for weeks on end and caused billions of dollars in damages. So the state is currently investigating their relation to the wildfires that ran rampant in the fall, and they're expected to cost the insurance industry in the range of 7.5 to $10 billion. So just to put that into perspective, California, a state that goes to wildfires, and they're pretty, they occur a decent amount there. Just last year alone, in 2017, they suffered around $12 billion of damages, and from this one event alone that lasted roughly a month, it's going to be costing 7.5 to $10 billion. So, what exactly does this mean for investors? This was the first ever catastrophe bond of its sort that covered specifically wildfire losses. There are others that have had wildfire losses within them, but they're not specifically for wildfire events. This was the first of its kind, and it solely protected wildfire damages. Investors are going to be suffering a significant losses if PG&E is deemed responsible. And PG&E only has $1.4 billion in liability coverage, including this, and that amount includes this $200 million bond. So it's going to be using all of it. And the graph that I have represented on the right, those following the cat bond market are anticipating for the worst, as the PG&E bond was quoted at 5 cents on the dollar this week, and this week was just a few days ago. I believe the article was published December 5th, which was down 95% from mid-November. Just to look at some other notes, bonds with partial exposure to California wildfires are less likely to be affected by the recent fires. Many catastrophe bonds are triggered only if the company's total losses hit a threshold, which is usually very high. And again, other bonds that have wildfires within them, they're such a small part of it. As again, this was like the first ever 100% catastrophe bond that covered just wildfire damages. Insurance and reinsurance industry will have enough in reserves to handle and absorb the expected losses. Some smaller companies could be hit hard though. And following 2017 wildfires, investors said they'd be more hesitant in taking on wildfire risk, considering that like an event like an earthquake is not human, like it can't be human oriented, whereas a wildfire, human error can be responsible on like an earthquake or a hurricane. And investors who take on the catastrophe risk are also they're used to volatility. So even if you have two bad years in a row, it doesn't necessarily mean the strategy or the space is wrong. Just to close everything out, I'd like to say thank you for everyone to listening to my presentation. And the two questions that I'd like to present to the class are two things that I was thinking about while reading this article, and that's, could you ever see yourself adding catastrophe bonds to your portfolio, whether it be in the near or distant future? And how do you think this will affect investors' perceptions of catastrophe bonds? Will they shy away from them overall, or just ones that are heavily oriented around wildfires?